Thank you. Good afternoon, ladies and gentlemen. I wanted to give a summary of the economic and the market environment in which we find ourselves in 2014. And as an economist, I have a bit of a problem. Our economic forecasts are boring this year. And economics, as you know, is rarely boring. The problem is, our view is extremely consensus. Or as we prefer to put it at UBS, the consensus is extremely UBS in its opinions. Everybody believes the world is going to have a gradual recovery. Everybody believes the United States will have a reasonably good year for growth. Everybody believes there will be a mediocre recovery in the Eurozone. Asia will grow, led by exports. There is very little difference of opinion in financial markets about where the world economy is going. I think that this is a result of where we are in the economic cycle today. That if I look at the States, there will be no fiscal tightening this year. That is certain. Congress has decided the budget until 2015. And we have a gradual improvement in bank lending this year. Also fairly certain there is very little likelihood that bank lending will suddenly collapse in the United States. So we have a very narrow consensus range. For financial markets, I believe this is very dangerous. Because when the consensus is very narrowly focused, investors, hedge funds, institutional funds are looking to try and differentiate themselves. No one is ever paid money for performing as well as everybody else. Everybody wants to outperform. And what we are seeing at the moment is a tendency in markets to overreact to very small events. And I believe that as we go through this year, we will see more overreactions coming through. And there are three areas of concern that I have as sources of financial volatility in 2014. First, the Federal Reserve. Second, European politics. And third, Japan's role in Asia. For the Federal Reserve, the point is not that there is any uncertainty around quantitative policy. Quantitative policy is going to be steadily reduced at a rate of 10 billion a meeting and conclude in October this year. It is on automatic pilot. Quantitative policy in America is being run by Ben Bernanke from beyond the grave, or Princeton, which is the same thing. Effectively, it's not the quantitative policy that worries me, it's the monetary policy. Markets have a very, very benign view of the Federal Reserve's actions next year. The market believes that there will be 2, at the most 3 rate hikes. That may very well be true, but I think the certainty around that will be challenged in the second half of this year. As the US economy continues to grow, we believe the labor market will improve and spare capacity in the American economy will slowly be reduced. That is the consensus view. The problem is no one knows for certain how much spare capacity exists within the US economy today. And that uncertainty has spread even to the Federal Reserve. And I think that there will therefore be a very public argument about how much spare capacity America has and how quickly interest rates will need to rise next year. In particular, there are, I think, two potential fault lines. The first is the appointment of Stanley Fischer as Vice Chair of the Federal Reserve. Stanley Fischer is undoubtedly the most powerful Vice Chair the Fed has had at least since the 1930s. He ran his own central bank, admittedly only the Central Bank of Israel, but it is still a central bank. He is a strongly opinionated individual. At 70 years old, he doesn't care what other people think about him. He is going to speak his mind. And his mind is not the same as Janet Yellen's. Yellen is a classical Keynesian labour market economist, whereas Fischer is effectively a soft version of monetarist. There will, I think, be disagreement between these two, which will be public and create uncertainty about the direction of US policy. Secondly, the Federal Reserve staff economists do not like Yellen. This has arisen because when she was at San Francisco as Fed president, she worked with a very small group of close advisors, and she ignored the economists of the Federal Reserve. She didn't share her views with them. She didn't ask their opinions. Economists, as I'm sure you know, are sensitive people. They get very upset if they are not listened to. This resentment is a problem because the economists of the Federal Reserve believe there is less spare capacity in the US than Janet Yellen does. And already we are starting to see research from the Fed that is effectively criticizing the FOMC decision and raising doubts about whether Yellen is taking the Fed in the right direction. These two fault lines within the Fed, I think, will add uncertainty and volatility over the summer, which will be particularly felt at the longer end of the yield curve as we add additional risk into government bond markets. Also over the summer, though, I think we have the second fault line in global markets, the second source of volatility, European politics. Over the last 6 years, Europe has experienced a decline in real household incomes. Virtually every country in Europe has seen the standard of living fall in real terms. But what is particularly troubling is that alongside this, income inequality has risen. This makes the middle class extremely upset. The middle class can accept a decline in their standard of living. What they absolutely will not tolerate is a decline in the standard of living when their next-door neighbour is doing better than they are. And in this environment, the middle-class voter is looking for someone to blame. They're blaming their government, which is fair enough. They are blaming investment banks, which is completely unfair. And above all else, they are blaming the foreigner. There has been an alarming rise in anti-foreigner, anti-immigration sentiment in Europe over the last 3 years. And if you look at the latest opinion polls, in a large number of countries, anti-immigration parties are polling 20% of the vote or more. This matters because, I believe, the European parliamentary elections at the end of May will see anti-immigration parties receive 25% of the seats. These anti-immigration parties are all also anti-Europe parties. And the concern here is that the image of Europe is going to suffer. I can bet that the first week of June, CNBC's headlines, with all the characteristic in-depth reporting CNBC does, is going to be 25% of Europe votes to leave Europe. That's not true, but that's the image the world is going to have. And the problem from that is that foreign investors outside of Europe have been the key marginal buyer of European assets over the course of the last 6 months. Presented with an image where Europe is voting against Europe, where extremism is on the rise, I fear very much that that support for European markets will be temporarily, perhaps, lost. And that will add volatility to European financial assets. So in the US, we have uncertainty in a negative sense about the Federal Reserve. In Europe, we have a potential risk arising from politics. In Asia, I think the risk is more positive, at least for most of Asia. In Asia, I think the role of Japan is a potential upside source of volatility for financial markets. Put simply, Abenomics is not working in Japan. Abenomics has, in fact, failed. The attempt to stimulate the Japanese economy is not working for the very simple reason that Japanese companies and Japanese banks are taking the stimulus and putting it to work outside Japan. The fastest growing area of Japanese bank lending today is Japanese bank lending outside Japan, not inside. That is because the Japanese banks see very little future in lending in Japan. Most of this lending, not all, but most, is directed towards Southeast Asia, and I think it provides a potential support to that economy. Secondly, the corporate sector is signaling its disapproval of Abenomics by borrowing money cheaply in Japan and investing it outside. Foreign investment by Japanese companies is now running at anywhere between a fifth and a third of domestic investment, a truly staggering proportion. Normally, foreign investment runs at about 5% of domestic investment in a developed economy. In Japan, it's currently hovering around 25%. It has been as high as 35%. Japanese companies are saying we do not want to invest in a country with an aging society, a declining workforce, uncertain power supplies, and the wrong skills levels. And increasingly, Japanese companies are blaming the lack of skilled workers as the reason for moving offshore. Where are they investing most? They are investing most into Southeast Asia. With the recent data coming out of Japan showing further weakness in the economy relative to expectations, with the government's approval rating steadily sliding downwards, I think that we will be seeing more attempts at monetary stimulus from Japan, which will be as ineffective in the domestic economy as the last stimulus. But this will, I think, continue to leak out and therefore provide potential positive shocks within the Southeast Asian region and maybe somewhat further afield. So my view is that the growth story, the headline numbers, the general picture this year is not going to be where the excitement is. I think that the issues that we need to look for are small issues that provoke overreaction in financial markets. And when everyone has a consensus view, the risk of overreaction is very high. I think that the Fed is the first and the biggest area of volatility. International reaction to European politics is going to be an overreaction, but I think is going to affect European markets this year. And finally, as Abenomics quietly fails in Japan, it does provide interesting alternative opportunities elsewhere in Southeast Asia. All of these issues, I think, create volatility and uncertainty in financial markets, even though the economic climate is relatively stable. The climate of uncertainty and volatility, frankly, is something I personally welcome. The more uncertain the world is, the more we need to employ economists to explain it. Thank you very much.